The last time I saw conditions like this, I called my closest advisors into a room, closed the door, and told them prepare for something the textbook said couldn't happen. That was 2007. Nobody listened. 18 months later, the entire global financial system nearly stopped functioning. I'm calling that meeting again, and this time I'm opening the door. What is about to happen to gold and silver is something the mainstream financial world has dismissed, laughed at, and ignored for the last decade, not because the evidence wasn't there, but because it means admitting how broken the system has already become. And the people running that system are not ready to make that admission, but I am. Before we go further, if you're the kind of person who takes this seriously, who wants to understand the financial system before the crowd does, not after then, I want to invite you to something. Our channel memberships exist for exactly that purpose. EA Wealth Apprentice, Wong Financial Titan, Banking Insider, Sherman Circle members get exclusive financial insights, content, and special members-only updates designed to help you stay ahead of the economic shifts most people never see coming. Click on the join button below and become part of the inner circle, because what I'm about to share in this video is the kind of information the members came here for, and it starts right now. Let me tell you what nobody in a suit on television is saying out loud. Gold is not just rising, it is re-rating. There is a fundamental difference between a price going up and a price undergoing a structural re-rating, and most investors have never lived through the second one. A price going up means demand increased or supply tightened and the market adjusted. Normal, expected, temporary. In many cases, a structural re-rating means the underlying value proposition of the asset has changed permanently, that the world's relationship with that asset, what it represents, what it protects against, what it replaces, has fundamentally shifted. Gold is being re-rated right now in real time, and silver is about to follow with a force that will make gold's move look modest by comparison. Let me show you why. In the last 18 months, central banks around the world have purchased more gold than in any comparable period since not hedge funds, not retail investors, not speculators. Central banks, the institutions that issue currency, the institutions that are supposed to be the embodiment of confidence in paper money, those institutions are quietly, systematically moving their reserves into gold. Think about what that tells you. When the people who print money start buying the thing that money was originally designed to replace, that is not a routine portfolio adjustment. That is a signal, and it is the clearest signal I have seen in my career about where the people who actually control the system believe it is heading. China's central bank has been buying gold every single month for over 2 years straight. They don't do that casually. They do that with purpose. Russia, despite everything, has been building its gold reserve steadily for over a decade. They understood something early that most Western investors still haven't processed. And now Poland, Hungary, India, Turkey, countries across the emerging world are doing the same thing. This is not coincidence. This is coordination, and it is happening in plain sight. But what happened next was worse, or rather more, because while central banks quietly accumulate, the Western public is almost completely unaware, and no one is talking about the real danger hiding behind those numbers, because the central bank buying is just the first layer. Underneath it is a story about the dollar's role in the world that has been quietly but decisively shifting, and when that shift reaches its critical inflection point, what happens to gold and silver prices is not something most people are emotionally prepared for. I'll get to that, but first I need you to understand the setup, the conditions that have to exist before the unthinkable becomes inevitable. Because once you see the setup clearly, you will never look at your savings the same way again. Think back to Vietnam had cost the country enormously, financially, socially, politically. The dollar was under pressure. Foreign governments, particularly France under de Gaulle, were nervous. They started doing something that was entirely within their legal rights under the Bretton Woods Agreement. They started converting their dollar reserves into gold. President Nixon faced a choice: honor the commitment, let the gold leave, accept the discipline that a gold-backed currency imposes, or close the gold window, break the promise, untether the dollar from any physical constraint. He chose option 2 on a Sunday night in August 19 without warning the world, without consulting allies, without a vote. Nixon ended the gold standard. The dollar became in that moment backed by nothing except faith. And what happened to gold after that decision? It went from $35 an ounce, the fixed rate had been pegged at for decades, to $850 an ounce by 1980. A 24-fold increase in 9 years. But here's the truth nobody wants to hear. The decision being made today is bigger than 19, and the response in gold and silver, if history rhymes even loosely, will be proportionally larger. Let me be blunt. Most people are going to sit through the next 3 years watching gold and silver move, and they are going to tell themselves one of two things. Either I knew this was coming and I still didn't act, or I never saw this coming and now it's too late. Neither of those outcomes is acceptable to me, and if you're still watching, I don't think it's acceptable to you either. So let's talk about what's actually driving this. Not surface level narrative, not the talking points, the actual structural forces that are now converging in a way that makes the unthinkable, not just possible, but mathematically likely. There are 3 of them, and each one alone would be significant. Together, they are historic. I'll give you the first one. Now, the second and third are in part 2, and the third one, the one nobody's discussing, is the one that changes the entire picture for silver specifically. The first force, the weaponization of the dollar. In 2022, something happened that changed the way every government on earth thinks about holding U.S. dollar reserves. The United States and its allies froze $300 in Russian central bank assets. Now, whatever you believe about the geopolitics, whatever your position on that conflict, set it aside for a moment, because the financial implication of that decision was seismic. It proved beyond any doubt that dollar reserves held in Western institutions are not unconditionally safe. They can be seized, they can be frozen, they can be used as a weapon, and every government on earth, ally or adversary, friend or neutral, received that message simultaneously. If it can happen to Russia, it can happen to anyone. And the response, diversification away from dollars, away from dollar-denominated assets, and toward the one asset that cannot be frozen, cannot be seized remotely, cannot be weaponized by a foreign government, physical gold. If you want to stay ahead of the financial system, understand why silver could become one of the most valuable assets of the coming years, and learn the wealth strategies smart investors use before the masses catch on. Subscribe to the Diamond Standard. Here we uncover the hidden truths about silver, economic shifts, wealth protection, and the financial opportunities most people never see until it's too late. That's force number 1. In part 2, I'll show you force number 2, which is happening inside the U.S. financial system itself, in a place most people never look. And force number 3, a silver-specific catalyst that has no historical precedent. When all 3 converge, and they are already converging, the word unthinkable stops being dramatic. It becomes a forecast forces 1 collision, your money in the middle. There's a number that I want you to hold in your mind for this entire section. That number is 8. That is the average length of time between the moment a major monetary shift becomes inevitable and the moment the general public finally accepts it as real. 8 years of evidence, 8 years of signals, 8 years of the people who understand what's happening quietly repositioning while everyone else waits for permission from the news cycle. The shift I've been describing started in 20, the math. We are inside the window, and the 2 forces I'm about to show you are the ones that close it. The second force is debt spiral, and I know you've heard about American debt before. I know the number 34 trillion, 35 trillion feels abstract, meaningless, almost too large to be real. So let me make it real. The United States government currently spends roughly $1 trillion per year on interest payments alone. Just interest, not programs, not military, not roads or schools or Social Security. Interest on money already borrowed, already spent, already gone. That $1 trillion figure is larger than the entire GDP of countries like Saudi Arabia, Switzerland, and Argentina, and it is growing. Every time the Federal Reserve raised interest rates to fight inflation, which was the right thing to do for inflation, it made the debt more expensive to service. It compounded the problem. The cure and the disease were working against each other simultaneously. Now, here is where it gets dangerous. The U.S. government needs to roll over, refinance approximately $9 trillion in existing debt in the next 2 years. Debt that was originally borrowed at near zero interest rates, which now has to be refinanced at 4%, potentially higher. The interest bill isn't going to stay at $1 trillion. It is on track to hit $1.5 trillion, then $2 trillion at some point, and we are approaching that point. The interest payments consume so much of the federal budget that the government faces a binary choice. Cut programs, raise taxes to levels that would be politically unsurvivable, or do what every over-indebted government in history has eventually done, inflate it away. And the moment the market truly believes in its bones, that the U.S. is committed to an inflationary path as the primary debt management strategy, gold and silver will not go up, they will surge. But what happened next in previous cycles was the part they leave out of the history books. It wasn't just that gold went up, it's that it went up so fast, so violently, that the people who waited for confirmation, who waited until it was obvious, until the news was covering it, until their friends were talking about it, those people missed the majority of the move because markets don't wait for consensus. Markets move on intrinsic. And the investors who made generational wealth in the 1970s gold bull market weren't the ones who bought when Nixon made the announcement. They were already positioned. They understood the trajectory before the catalyst. And the investors who are going to make generational wealth in this cycle, they are positioning right now while the mainstream financial media still calls gold a barbarous relic, while the consensus still believes the Fed can engineer a soft landing, while your financial advisor is still recommending the same 60-40 portfolio that was designed for a world that no longer exists. I want you on the right side of this, which is why force number 3 is the most important thing I'll say in this entire video. This is the one nobody is talking about, and I mean that literally. I've sat in rooms with some of the sharpest financial minds in the world. I've read every major investment bank's research on precious metals over the last 3 years. And this particular dynamic, this specific collision of forces that applies uniquely to silver and not gold, is almost entirely absent from mainstream financial discussion. Here it is. Silver is the only asset on earth that is simultaneously a monetary safe haven with thousands of years of value preservation history, a critical industrial import with rapidly growing irreplaceable demand, and structural supply deficit where the world consumes more than it mines, and yet trading at a historic discount relative to its monetary partner gold. Every single one of those conditions is independently powerful. Together, they are unprecedented. Let me break down the industrial demand side because this is where silver's story diverges completely from gold's in the years ahead. Solar energy, the global solar installation rate, has nearly doubled every 3 years for the past decade. Every solar panel requires silver, not as a trace element, as a core functional component. Silver is used in the photovoltaic cells because it is the best electrical conductor on Earth, and nothing commercially viable has replaced it. The International Energy Agency projects solar capacity will triple by 2030 compared to 2022 levels, triple. That demand growth alone, just the solar sector, would absorb silver supply at a rate the mining industry cannot match. And solar isn't the only story. Electric vehicles use 2 to 3 times more silver than conventional vehicles. The entire electrification of transportation, every EV, every charging network, every grid upgrade required to support it, runs on silver-board 5G infrastructure, medical devices, defense electronics, semiconductor fabrication. Silver is in all of it. And unlike gold, which can be recycled from vaults indefinitely, most industrial silver is consumed, used, destroyed in the manufacturing process, unrecoverable. There is no recycled silver coming back to market to cushion the supply gap. And here's the number that should stop you cold. Silver mine supply has been essentially flat for a decade. Industrial demand is accelerating. The Silver Institute documented a supply deficit of over 200 million ounces in a single recent year. That is not a rounding error. That is a structural imbalance that doesn't correct itself without either a significant price increase to incentivize new mining investment or demand destruction. And demand is not being destroyed, it is accelerating. This changes everything. I need you to sit with that for a moment. You have an asset, silver, that has been used as money for 5,000 years, that is in structural supply deficit, that has industrial demand growing faster than any commodity analyst projected 5 years ago, that is trading at an 80:1 ratio relative to gold, historically one of the most extreme undervaluation on record, and the monetary conditions, the debt, the inflation risk, the dollar confidence question are the most favorable for precious metals, since what would you call an asset with all of those characteristics? Your financial advisor would call it speculative. The financial media would call it volatile. The same analysts who missed 2008, who missed the 2021 inflation surge, who told you bonds were safe when rates were at zero, those people would tell you to be cautious. Most people will ignore this. That is not a criticism. That is how financial history has always worked. The opportunity exists precisely because most people ignore it. The question is which group you're in. If you want to stay ahead of the financial system, understand why silver could become one of the most valuable assets of the coming years, and learn the wealth strategy smart investors use before the masses catch on, subscribe to Diamond Standard. Here we uncover the hidden truths about silver, economic shifts, wealth protection, and the financial opportunities most people never see until it's too late. In part 3, I'm going to show you exactly what the unthinkable looks like when it arrives. Not the slow grind, the event, the moment when the price of gold and silver stops moving like a financial instrument and starts moving like something else entirely. I've seen it once in my career in one country for one asset, and I'll show you why the conditions for it happening globally to gold and silver simultaneously are more present today than at any point in modern financial history. Part 3 is where this gets very real. the day the price changes and never comes back. I want to tell you about a day, not a theoretical day, not a scenario, an actual day, a specific morning when the price of an asset moved in a way that made everyone who hadn't bought it feel physically ill. Not because it was dramatic, but because it was permanent. There was no dip to buy. There was no correction. There was no moment where the patient investor who waited for a pullback got their entry. The price moved and it never came back. That is what a structural re-rating looks like in real time, not the slow grind upward that gives everyone time to feel comfortable and participate. The sudden, violent, irreversible rip bricks where the asset finds a new equilibrium at a level that shocks everyone who wasn't already positioned. I am telling you with everything I know, with every pattern I have watched over 40 years in finance, that gold and silver are approaching that day, and when it comes, the window will not stay open. Here's what most people don't understand about precious metals bull markets. They don't build gradually to a peak. They have a long base building phase, often years, sometimes decades, followed by a compression release that happens faster than anyone expects. The base building phase for gold started around 20, for silver around the same time. We have been in that base for years. The patient investors, the ones who understood the structural case, have been accumulating during that phase quietly without headlines. And what ends the base building phase? What it triggers the compression release? It is always the same thing. A moment of clarity, a moment where a critical mass of investors, not retail investors, not YouTube viewers, not financial Twitter, but the large institutional money, the sovereign wealth funds, the pension funds managing trillions of dollars, suddenly collectively update their view of the risk. They don't need to believe in gold philosophically. They don't need to be gold bugs. They just need to believe that the risk of not having it is greater than the risk of holding it. And right now, that inflection is approaching. Let me show you exactly how close. For the last 30 years, the standard institutional portfolio, the model that every pension fund, endowment, and sovereign wealth fund defaulted to allocated approximately 0 to 1% precious metals. The logic was simple. Gold doesn't pay a dividend. It doesn't compound. In a world of 2% inflation and stable monetary policy, it's a deadweight drag on returns. That logic made sense in that world. That world is gone, and the institutions are beginning to realize it. When inflation ran at 8, 9, 10%, and the safe assets in those portfolios lost 20, 30, 40% of their value in real terms, the conversation in those boardrooms changed slowly at first, then faster. I've had those conversations. I know how they go. The first stage is denial. This is temporary. Policy will normalize. The second stage is acknowledgement. We need to review our inflation hedging strategy. The third stage, and this is the dangerous one for anyone not already positioned, is allocation. When pension funds managing 10, 20, $50 trillion in assets decide that even a 2% allocation to precious metals is prudent, the math is staggering. 2% of global institutional assets flowing into gold and silver markets that are a fraction of the size of equity or bond markets simply is fixed. It cannot increase quickly. Mining takes years of permitting, years of development, years of capital expenditure before a single new ounce comes to market. And here is no one talking about what happens when institutional demand meets constrained supply in a market that is a fraction of the size of what that institutional demand represents. The answer is the price does not gradually adjust. It gaps. In 1979 and 1980, two brothers, Nelson and William Hunt, attempted to corner the silver market. They accumulated somewhere between 100 million and 200 million ounces of physical silver. That represented a significant fraction of the world's above-ground silver supply at the time. What happened to the price? It went from roughly $6 an ounce in early 1979 to nearly $50 an ounce in January 19. Now, the Hunt brothers were doing something deliberate, something manipulative, and something that ultimately destroyed them when the rules were changed against them. I am not romanticizing what they did, but I want you to understand the physics of what happened. Two individuals with significant but not unlimited resources moved the silver price eightfold in 14 months simply by removing supply from the market. Now, imagine not two wealthy brothers, but a wave of institutional investors collectively deciding that silver belongs in their portfolios. Imagine not manipulation, but genuine recognition of the structural supply deficit and the monetary conditions. Imagine the same physics, inelastic supply meeting surging demand in a market where the industrial demand story didn't exist in 19. In today, it is the dominant global narrative around electrification and clean energy. The unthinkable is not that silver could do what it did in 19, which it could do it. Here's the truth nobody wants to hear. The financial advice that protects wealth in a stable, low-inflation, dollar-dominant world is the same financial advice that destroys wealth in the world we are entering. Diversified stock portfolios, long-dated bonds, cash and savings accounts earning rates below real inflation, index funds weighted heavily to tech stocks, priced for a future that requires cheap capital that no longer exists. These are not bad ideas in the abstract. In the right environment, they're sensible, responsible even, but environments change, and the speed at which most investors update their frameworks is tragically, reliably too slow. I have watched this happen 3 times in my career. The people who moved first, not recklessly but decisively with clear eyes and a solid understanding of the forces at work, protected and multiplied their wealth. The people who waited for certainty, who needed the newspaper to confirm what the data was already telling them, paid for that certainty with a diminished financial future. I am not willing to let that happen to the people watching this without at least having the conversation. Your 4 is not safe in the system as currently configured. Not because of a conspiracy, not because of some secret lead agenda, but because of simple documented mathematical reality of $34 trillion in debt, accelerating interest payments, a central bank that has already proven it will print when cornered in a global reserve currency system under its most serious challenge in 50. That reality does not care about your political preferences. It does not care about your comfort. It does not negotiate. It just unfolds. And the people who have already decided what they're going to do when it unfolds, they are sleeping better than the people who are still hoping it works itself out. Gold has half survived the fall of every empire that has ever existed, every currency that has ever been debased, every government that has ever overextended. Silver has done the same and is entering an era where its industrial indispensability adds a demand floor that gold has never had. The unthinkable is simply this, that the financial common sense of the last 30 years, the world of cheap money, stable inflation, and an unquestioned dollar is over. And in its place is something new, something the textbooks haven't finished writing yet, something that the investors who understand monetary history have been preparing for quietly, patiently, deliberately. You now understand what they understand. The only question is what you do with that understanding. Most people will do nothing. I hope you're not most people. If you want to stay ahead of the financial system, understand why silver could become one of the most valuable assets of the coming years, and learn the wealth strategy smart investors use before the masses catch on. Subscribe to the Diamond Standard here, uncover the hidden truths about silver, economic shifts, wealth protection, and the financial opportunities most people never see until it's too late, because the window that exists right now, the window between before the institutional money arrives and after, will not stay open indefinitely. The investors who entered that window have already begun. The question is whether you enter it with them or watch from the outside when it closes. The unthinkable is already happening to gold, to silver, to the financial order that told you it couldn't. The only question left is whether you're watching